Hi everyone, this is Rohit from Lightspeed Mastery. I'm excited to have Ansaf Kareem, who's a partner at Lightspeed Ventures. Lightspeed Venture Partners is a global venture capital firm focused on investing in both enterprise and consumer sectors. Lightspeed manages over $10 billion of capital under management with offices in Bay Area, China, India, Israel, Europe, and Southeast Asia. Ansaf has done his MBA from Harvard and Bachelors from Stanford. A big thank you to Anna, who's also Ansaf's wife, for the introduction. Welcome to the show, Ansaf.
Thank you so much. Appreciate you having me.
Awesome. So, you do have a non-linear part to venture capital, but how did you get into the world of startups, and how was your initial journey of growing up and getting into grad school and then later on MBA?
Yeah, I'd say now looking back, I think I can trace a lot of my career interests back to growing up. I grew up in Oregon. Both my parents were immigrants from Pakistan. My dad was an engineer and spent time in the tech industry, and my mom was a social entrepreneur and started a nonprofit focused on helping refugees settle in the U.S. And with their social needs. And I think both of those strands kind of played a part in the role that I wanted to have in my own career, both from an interest early on in technology and the impact technology can have, but then also having a thought or a view around how do you live a life that has an impact towards others. And so I think both of those strands kind of fed me. Even when I was in college, I was fortunate to go to Stanford for undergrad, and when I was there, I thought I was going to probably go into some kind of government role when I graduated, maybe work for the State Department or do something like that, because at that time I thought that was the way you could have an impact at scale. But when I got to campus, I realized that there was this thing, which I didn't even know had a name, called entrepreneurship at the time, but basically small groups of people working together on fun projects. Actually, Lightspeed at the time had a summer fellowship program, which basically allowed you to apply as a student with an idea, and they'd give you some small amount of funding and basically be able to work out of their offices. So I got exposure actually initially to the idea of entrepreneurship, this idea that you could get money to work on exciting projects with your friends. And that's how I first got hooked onto this idea of tech and startups. I had an opportunity to also work with a small seed stage firm back then that was focusing on writing really small checks, mostly focused on areas of also impact. And it got exposed me for the first time also to the venture landscape and what the opportunity could look like there, to be on the other side of the table with partnering with entrepreneurs to help them scale. So I was lucky that through my college experience, I got some exposure to what this world looked like. And my path from there, though, kind of took a little bit of a random path in some ways into how I got into venture. I spent time originally at McKinsey because I wanted to go and actually get a sort of for business education. And so I spent about 2.5 years working at McKinsey. I spent a lot of time I was in the New York office. So by nature, I spent a lot of time working with the top financial institutions in the US, mostly on their consumer businesses. So, credit cards, wealth management, mortgages, retail branches. And this was sort of right around the time after the crisis. And so it's a very interesting time within those banks in terms of how they thought about strategy. And also informed a lot of my investments later on in the Fintech realm in terms of where banks were underserving or not able to meet the needs of so many consumers in the US and abroad. I then spent some time, mostly following my passion, where I found a politician named Cory Booker, who was back then mayor of Newark and then eventually ran for Senate from New Jersey. And I got a chance to work with him on the policy side. So it was a great, interesting experience to just see, in some ways how some of the sausage was made and how the regulatory part and the political and policymaking part of the world sometimes intersects with the tech world and oftentimes doesn't at all, but it's an interesting part of the equation as you think about any business venture. And then I got to spend some time both in grad school as well as in the startup called Relate IQ, which was in the enterprise CRM space, which we ultimately sold to Salesforce back in 2014 for about $400 million. And then, when I was in grad school, I was thinking through what I wanted to do next. And I had a lot of ideas and passions around, potentially starting a company or potentially, being on the investing side. And I think when I got a chance to meet the partners at Lightspeed, I think it became evident and clear that, the investing side could bring a lot of fulfillment, both personally in terms of the support you get to offer entrepreneurs at the earliest stages of their journey, but also a place that, I felt like had a desire to really have a big and outsized impact in the venture landscape. And so that was almost 5 years ago now. And I've been lucky to continue to be doing what I'm doing.
No, I think it is super interesting because you've been with some really great Ivy League brand names. Especially wanted to understand how was the experience in public policy and at McKinsey. Did it really help you have that professional experience to be a good investor, or do you think a lot of MBA students would do you think it helps to have an operating experience before they become investors?
Yeah, it's a good question. I mean, I think as an investor, all your past experiences kind of inform your thoughts and your views about businesses and opportunities. And I think the more expansive it can be, oftentimes actually it opens up your eyes to where there might be opportunities where other people might not be looking. In particular, I think the McKinsey skill set early on in the career was helpful just to be able to build the building blocks of how you think about analysis and understanding and unpacking businesses, but also on the client side, which ultimately VC in many ways is a partnership opportunity with entrepreneurs, and being able to understand how do you empathize and communicate with someone who you're not directly in the trenches with day in and day out, but are trying to help and shepherd into a larger opportunity. In some ways, some of that consulting experience was helpful and additive. But I'd say the sort of broader just breadth of experience has been helpful in terms of understanding many of the nuances that may exist in so many different sectors. Even on the policy side, when I think about some of the fintech investments, like I mentioned, obviously working with banks was helpful, but also on the regulatory side, really understanding, how do policymakers potentially think about, whether or not they will continue with regulation that helps or doesn't help fintechs. How would they think about something like the Durbin Act in the U.S., which is, sort of the basis upon which many fintech models are based upon? Is that going to continue or not continue? So having a little bit of an exposure to that world as I help, as I focus on some of these regulated areas, has actually been pretty additive and helpful as well. So, none of this was planned, obviously, but I think looking back, I can tell that those experiences can be certainly helpful. I think on the business school side, I think the biggest advantage of business school, as many people cite, is just sort of the network and the people you meet. And there's so much exposure through osmosis to people who have very different interests and likes and come from all over the world that you can meet oftentimes in these graduate school programs. I think that's probably the most great experience, especially as for my job now, as technology gets more and more internationalized, the ability to have friends, networks, contacts in places all over the world who are in tech or not in tech, but have some local context. I think that's been very helpful in more recent months as we've also looked, abroad for some of our own investment areas and ideas.
No, I think that's super interesting and helpful. And you've been working at Lightspeed. Want to understand for a VC, how does the decision making process happen as a partner? How do you focus on making investments, and what is the entire decision making process there?
Yeah, I think sometimes it can be kind of opaque from the outside in terms of how some of these firms operate, and so I'd love to try to shed some light into it. I think at our firm, although we're a big firm, we're also a reasonably lean firm, and I think the way that we like to operate is that each individual partner likes to build conviction around areas that they're excited about, but very quickly loops in other folks who have expertise in that area or adjacent interests in that area. And so whether it's a seed deal of $2 million or a pre-IPO deal, we form what's called deal teams around these opportunity sets. And obviously one partner will be leading the charge in many ways, but there will be a group of 1, 2, sometimes 3 partners who will have exposure to the company, be part of the diligence process, and help get to a initial perspective around the company. And eventually, for almost all deals, they go through a formal investment committee process where the company will come and present to the partnership, to the broader partnership, and sort of the case will be made by the deal team with a memo and other details to support it around why this investment is a good investment or what are some of the risks associated with it. And out of that meeting, usually comes an answer around, should we move forward with this investment or not? But the beauty of that approach is that it allows for individual conviction, but it also helps build consensus in a way that feels very natural to both the entrepreneur, but also internally in terms of our ability to move fast and execute some of these deals as they come through the door.
Correct. And how would VC firms look at reserve allocation? This is in context if you're investing at the seed stage. How do you look at reserve allocation, and how do you decide, which companies to double down, and in which companies should you get on to reserve constrained capital?
Yeah, I'd say generally, from our context, at least at the firm, we're very much focused on high concentration, high conviction bets, right? And so when we think about the investments we want to make, we're really thinking about it through that lens of, we're getting onto a journey, especially at the early stage with the founder for the next, 10 plus years. And some of our best companies that have, reached IPO or large exits have been 10 plus year journeys, and whether that's a MuleSoft, App Dynamics, or Affirm, these companies have all startups take a while to get to that type of scale and that type of outcome. And so I think the mindset at the firm is very much focused around how do we not only find and partner with those entrepreneurs and those businesses, but also understand that as capital partners to those entrepreneurs, we need to have a structure that can support them over the life cycle of the company and through both ups and downs. And so that's how we've always thought about reserve allocation as well, that for our companies, we make sure that we've got the right amount of reserves so that we can continue to support that company for their next round for sure, and oftentimes even beyond that. And the way that our funds are structured, we have a early stage fund, a growth stage fund, and an opportunity fund. And in many ways, our companies sometimes graduate through those different funds as well. You might have a early stage investment to a company. As the company scales and we decide to put more money into the company and support that company, they might come out of a different fund and so on. And so our whole strategy and fund strategy is also oriented around supporting our partners in that way. I think, more broadly, as I've met with a lot of other seed firms and other firms who think about reserve allocation differently, I think there's no one right answer for any firm. Some firms that are on the seed stage, that might be their first firm, or it might be smaller, they might do less reserve allocation just because they've got more companies. And if you end up reserving for every company, that can be a tough equation for a smaller fund. Also other larger funds have a different strategy around how they want to think about support for companies over the long term. So I would definitely say there's no one size fits all, but for us, because we are, high conviction and concentrated investors, we try to make sure we've got the right reserves over the life cycle of a company.
All right. And, how does, I understand, there are not a lot of, you have a very lean team, but how do you look at sourcing deals? Does a partner also look at sourcing deals, or do you leave it to associates and principals for sourcing of deals?
Yeah, I'd say most folks are also sourcing deals and looking at net new deals. A lot of it, as you know, comes through both referrals from folks that you've worked with in the past, other seed investors, other folks who you've collaborated with, other folks in the venture ecosystem, startup ecosystem. But also, there's no substitute for reaching out directly to companies and making sure that you can spend time to do that kind of direct outbound and contact with entrepreneurs. And so I think it's a healthy balance of both the referral system, but also the outbound. And then within the firm, we've got a very healthy culture around, clearly if it's an area that I've spent a lot of time in, or my partner spent a lot of time in, passing along deals to each other as well, because what we want for the entrepreneur is to have the best partner from the Lightspeed team to be able to partner with you on your journey. And so, if it's a, deep enterprise infrastructure company that I may not have great context or background in, I'll pass it to one of my partners who might be able to better both assess the company, but also honestly be a better partner for that entrepreneur, and vice versa. If there's something in the fintech realm or somewhere that I've spent a lot more time, my partners will send me deals and say, hey, is this something you'd like to engage with and meet with? And so there's many opportunities that come through that as well. But fundamentally, sourcing, especially at the early stage, and especially in this environment, is such an important part of the business. And any firm that wants to, and any partner or investor that wants to continue to scale and do well in this business, sourcing is a key thing to focus on and continue to build muscle into.
Got it. And for VCs who budding VCs who just getting into this world of venture ecosystem, what is the best way to build their reputation, most effective way to build their reputation and get the best of deals?
Yeah. It's a good question. And similarly, I got this advice when I first joined the venture world, which was, there's no one way to do venture, and you should try to match your personality to the way that you approach venture, right? And so there's some folks who are, naturally great, for instance, at, building brands online. There's some folks who are naturally great, maybe because of their past experiences, about being that sort of operating partner for an entrepreneur. There's some folks who are extremely intellectual about the way they approach investing, but can help provide a very different type of value for entrepreneurs and the way that they engage their audiences more broadly. So I would say that I don't think there's one size fits all for anybody. If someone's entering for the first time, what I would really say is it does seem like a must these days that you have to have a way for entrepreneurs to get to know you before they even know you. So what does that usually mean? Oftentimes that can mean an online presence, whether that's Twitter or Medium or other platforms, to be able to say, hey, if I want to look you up before I meet you, what does the internet tell me about, myself on and this potential investor of mine? And so I think that's an important thing for any investor to think about. The second thing, which, is more and more important, but hard to jump start at the beginning of your career, but very quickly many folks will be able to build on this, is sort of your reputation, both with other investors, but also with entrepreneurs. And so the ability of, an entrepreneur to talk to their own entrepreneur friends, or maybe their seed investors if they're looking at a Series A investor, and say, hey, do you know this person, or have you worked with this person? That reputation, pays out a lot of dividends. And so making sure that, as you think about this as a VC in this game, or in this market, how do you make sure to understand this is a long-term game, and so that, and a repeat game. And so the way that you interact with folks, the way you engage with folks, the way you even pass on investments, all of that adds up over time, and it builds sort of a body of work that is your sort of reputation, the way people know you in this ecosystem. And so I think that's an important thing for new folks to focus on, and not get too carried away with, just focusing on sourcing or moving fast or execution, because ultimately this is a people business.
Yeah, no, absolutely. I think you rightly pointed out it's a people's business, and I want to talk about in the context of founders. What do you think are the biggest mistakes founders make when they hit traction and they begin to scale? What's been some of the usual mistakes which founders make?
Yeah, it's a great question. I mean, I think there can be a lot of hiccups for any company. I think getting to product market fit by itself is a huge achievement. I mean, I think people sometimes underestimate the path from going to just 0 to 1 to product market fit. So I think once you hit that, as companies scale to the next stage, one of the things that comes to mind is the idea around how do you continue to expand product in a way that doesn't make you feel that feels comfortable, but also maybe a little bit uncomfortable. What I mean by that is that oftentimes when people get to that stage and they start to see something working, oftentimes they just want to double down into that, and that could be the right answer in many ways. But because of the pace of innovation, because of the pace of competition, and because of the pace that it takes to build a successful, fast-growing company, you have to constantly be thinking about your act 2 and your next product set. And so for many founders, sometimes getting out of that sort of mode of getting to product market fit and then now thinking, hey, something is working, continuing to expand your thinking beyond that, I think is one important thing. The second thing I would say is that, because, like I said, product market fit is oftentimes a hard thing to get to, really understanding the team building that it will take to get you to that next phase, because usually 0 to 1 means it's you and maybe a small group of your teammates who are really making this happen. But once you hit that product market fit piece and you want to start thinking about scale, the natural thing is to say, hey, well, this worked for me up to this point. Now I should continue this and keep the team maybe lean and small. And again, I'm not saying to go over hire or overspend, but really start to think about what are the key strategic hires that will take me to this next level. Oftentimes that can be a VP of product or VP of sales or a COO, somebody in that caliber who can help not only take stuff off of your plate, but really think through some of these next level challenges that will certainly emerge as you think about scale. And so oftentimes I see founders struggle to start saying, hey, is this really the right time that I should be bringing on somebody of that level? And obviously that's a contextual conversation you should have, with your team and with your investors. But more often than not, I often feel like people over hesitate to make that hire despite things are working and the product market fit is there. And now you need to figure out how do you scale to get to that next level. So those are probably two of the most common or frequent things that I encounter.
Interesting. And how do you test a founder's ability to execute on an idea when you meet him early on? Are there any cues you look at to understand that the founder could be able to execute with?
Yeah, it's a great question. I think especially at the seed stage, what we're really looking for, obviously, is a large market opportunity, but also a founder or a founding team that has founder market fit for that specific idea and for that concept. And so, what does that actually mean? I think there's some signals and some cues that you can pay attention to. One is obviously a founder's background. If you're building into a space and you previously came from a similar or adjacent space, oftentimes it becomes abundantly clear when you have the conversation with a founder. But even regardless, I think you can lean on some of that background to be able to say, hey, well, at least they've seen what maybe good looks like or what scale looks like at a company that is in a similar space, and now they're bringing some of those expertise to a different problem within that space. And I think that can be a very strong telling sign, or at least a helpful signal or input into that equation. I think a lot comes from the actual conversation you have with founders. I mean, because we do this day in and day out, you can tell when you speak with a founder, how much thought and detail have they gone through and really thinking through a model, especially at that sort of seed and pre-seed stage where, obviously you've got a vision, you've got an idea, maybe you've got a pain point, and you've thought about, some of the parameters that go into that. But I've seen very quickly some founders who've taken it a level deeper by really thinking through the details. Some have built more of an operating model, for example, knowing that most of those assumptions will be wrong, but at least having put the thought and the effort into saying, hey, here's what I think this could start looking like at scale. And so through that conversation, you actually can see that how much effort and thought a founder has put into it and how much sort of, intellectual scrutiny they have gone through in terms of thinking through that model. And it becomes oftentimes pretty clear who's done that work and who hasn't done that work. And then, lastly, especially at that seed stage, a lot of this is sort of whiteboarding with the founder and really saying, okay, well, this is your vision. Like, what could this be? How do we work together as a team potentially to think this through? And through those conversations, a lot of this is ultimately comes down to a personal conviction on the individual and your ability to work with that individual as they think about this long-term vision. But through those sort of interactions, you can pretty clearly get that conviction and say, hey, even if there's some big question marks here, I like the way that this person is open to feedback and open to collaborate and open to taking input and open to, helping me also get conviction on this. And that oftentimes gives you signal on their ability to do that with others, whether that's future execs, future investors, future partners. And so I think those are some of the things that we look for from a signal perspective when it comes to this amorphous idea of founder market fit.
Got it. And what advice would you give to founders who are looking to raise funds, and how do they get to decide which VC firm or partner should come on their board?
Yeah, it's a good question, and I think there are multiple things founders should do when they are assessing a potential board member. I think, and I'll talk more about the early stage versus the growth stage. That's where I spend more of my time. I'd say, one thing every founder should do is talk to founders that have worked with that investor before. Oftentimes, especially in this environment where deals are moving so quickly and decisions are being made, pretty fast. I'd highly recommend that founders make sure they speak with folks who have worked with that investor, and ideally in situations where it hasn't always been up and to the right. And so you can also understand, how did the investor react when things weren't going as well as planned? And I think that will be very telling, especially for early stage founders, in terms of this investor being part of their journey over a long period of time. So I think that's very, very important. I think also really understanding, oftentimes I've seen founders think about a firm versus a partner, and I think both are important. I do think actually firms as institutions can offer a lot of value to founders, both because many larger firms, including ours, have teams that help our portfolio companies as they think about scale. And I think that's intangible value that will be super helpful for many folks, especially at the early stage. But also really thinking about that partner in particular. What is their background experience in this space? And how do I, as a founder, feel when I work with that or talk through that founder with that investor about my idea? Is it something that I can see myself sitting in rooms, sitting in board meetings, sitting in whiteboarding sessions with that individual and say, hey, I'm getting value out of this conversation or this engagement, and there's insight here that will be helpful for me. And I've done things like fake board meetings, I've done whiteboarding sessions, I've done dinners and things like that to get to know people at a personal level. All of that I think is important, and it goes both ways, obviously, but specifically for the founder, I think to get that level of comfort is extremely important, especially in a time of Zoom where you don't always get to meet your investors in person or as easily in person. So I think that's certainly extremely important. And then I would really think about the firm's strategy, and that's why I mentioned a little bit earlier with regards to how we think about concentrated investments and what does that mean from the potential investors' board commitments. Is this their 17th board they're going to be joining with you, or is this their 7th board? And that makes a big difference in terms of their ability to be engaged and be helpful to you. What is it? How many investments a year does this investor make? Is this one of 20 investments this year, or is this one of 3 investments or 2 investments this year? And I think that makes a very big difference in terms of their sort of implicit level of commitment to you and your business over the long run. And then, lastly, I'd say is capital matters. And so is this fund able to scale with you as you scale your business? That, in this environment where obviously there's a lot of money out there, there's many different options, but I think it's, as many founders that I work with and our firm works with, as you get to build that relationship, it's actually pretty nice to be able to go back to the same investor and firm and say, hey, would you be interested in leading our next round? Would you be partners with us over this longer next step of this journey versus just this sort of singular moment of 12 to 18 months of this specific milestone and round? And I think for many founders that really resonates. So these are some of the things that I oftentimes, counsel my own founders that I work with, but also prospective founders to think through as they make these very important decisions. And again, in this environment where things move fast, I think it's of utmost importance for founders to really just take that moment, even if it's a full day or 2 or 3, to really go through that. And these days I've seen some firms put some pressure on timing or deadlines, and I just remind founders that the ball is truly in their court and they can push back on investors on timing and things so that they really feel comfortable around making this very important decision for them and their business.
Yeah, no, absolutely. I think, as you rightly mentioned, the ball is in their court, and they need to make the right decision. And following up on that, what metrics do you think an enterprise or software or a fintech founder should focus on in order to increase the value of the company?
Yeah, it's a good question. Look, I think obviously there's many at the pre-seed and seed stage, a lot of it is still a bet on the market and the founder. And so metrics, obviously, the more metrics you have, the easier it is to help paint that story. But fundamentally, most investors are making a bet on the team and on the market opportunity at that stage. I'd say as you get sort of Series A and forward, what really matters, is really demonstrating momentum. I think, historically, the ecosystem has provided these benchmarks of $1 million in ARR or a certain amount of month-to-month growth rates. What I oftentimes orient around more is around momentum in the business early stage, right? So can you demonstrate that, certain things are happening in your business, whether it's a fintech business or a SaaS business? Honestly, it's sort of different metrics, but similar concepts around, how fast and how rapid is your ability to scale month with month or quarter over quarter, which demonstrates that there's a strong pull for your product. It can still be small numbers or small dollars, but this idea that every month or every quarter, that increase or that jump is actually moving quite fast. And it matters because we're in this business of fast growth and exponential growth. And so if you can start to see some breadcrumbs around that pace, that actually gives me more indication of what's to come versus hitting some arbitrary number of, for instance, $1 million ARR, which might have taken you 18 months to get to. It tells me something very different versus you got to 500K in 3 months, might tell me a very different story. Similarly, I look, having spent time in product previously, I spend a lot of time really thinking and understanding product and product metrics. So especially for a lot of businesses that are on the consumer side, but also enterprise businesses, especially in the SaaS side these days, you have to be able to prove that your customers are engaged in your product consistently and frequently, and you're able to retain them over time. And so not just thinking about this from a logo or dollar churn perspective, but truly a weekly active users, daily active users perspective with your product. And I think that obviously makes sense on the direct to consumer side, but even on the enterprise side these days, the best products are products where people live and breathe that product day in and day out for your core customer. And so paying attention to those usage patterns and how they're changing and growing is another important thing that that I pay a lot of attention to, and we pay a lot of attention to as well. So I would really encourage founders generally to be oriented more around success metrics versus sort of these vanity metrics or these benchmarks that have been thrown out there previously around you have to hit 1 million ARR, you have to hit 100,000 users or whatever it might be to be able to raise your Series A. I think what people are really oriented around is how fast is your product growing, what kind of momentum do you have in the business, and how much do your customers love your product and how active are they in your product? Because those are things that are the foundation for longer term success versus just a generic metric.
Awesome, right. And I wanted to understand about fintech and crypto industry. It's really growing fast. Do you think there's going to be more unbundling the fintech space, and where do you see the cryptocurrency space, especially with China banning the crypto mining and there are a lot of regulatory policies across countries like India and China. Where do you see crypto market going from here?
Yeah, that's a big question. I'd say, first on the fintech side, I think we're seeing two interesting things on the fintech side, or a few interesting things I should say. One, I'd say that, in the US, what we've seen is sort of what feels like a first wave of companies that are, many of them are neobanks, that have captured a more broad-based generalist audience base. If you think Chime, super impressive company, serving sort of the 100 million Americans living paycheck to paycheck or living, sort of at the who are underserved by traditional financial institutions. But it's a very broad-based audience, and it's also allowed them to accrue a lot of value over time as well. I think what we'll see sort of in B2 of the fintech, at least on the consumer side, is much more verticalized and segmented approaches for some of these new businesses. So how do I find, as a founder or as a potential fintech, an area that feels like there's a big market opportunity, but is not going to be as broad as a company like Chime or a company like Square Cash, et cetera? It would be more focused on maybe a demographic. Maybe on the B2B side, it'd be focused on a vertical like construction or another area that has a lot of potential and customer market value, but is very hyper-focused on serving the needs of that demographic or of that archetype of consumer. And so I think we're already starting to see that, and we'll see more of that happen over the coming years. And then I think the other thing that's interesting on the international side is that there's a lot of innovation happening and all over the world. We spend a lot of time in LATAM, we spend time meeting some companies even in Africa and across the board. And some of the models have, reflections of what's happened in the US and the EU broadly, but they're very contextualized for the needs and the regulations of those specific countries. And for many of those regions and countries, I think we will see a lot of great large fintech companies emerge, both on the direct-to-consumer as well as the B2B side, who are solving for a lot of the needs that are, similar but different in terms of what that specific context may need. And because of this obviously massive internet and smartphone adoption, we're at a point in many of these places where I think you're starting to see the early signs of what that will look like even in the coming years. And so I'm very bullish on what's happening internationally as well. And the last thing I'd say, just more in the sort of US context, is sort of the infrastructure layer. How do you continuously make it easy for fintechs to launch? Like if you wanted to launch a neobank 10 years ago, the amount of hurdles and burden that would take is so high. Today, it's still hard, but it's much easier, and there are more playbooks and there's more tools out there that have helped that use case, for example, thrive and continue to succeed. And I think that will happen across the board with all sort of fintech use cases, direct to consumer B2B, where you'll see many companies coming in to help enable those use cases, help make money move faster, help make it easier to develop on top of the existing financial services rails. We're an investor in a company called Synctera, which is helping new fintechs basically launch on top of partner banks as an example of that. And I think we'll just see many more iterations of companies who are trying to make it easier for developers to basically build fintech products. And so that's a way that we're generally very bullish on as well, and we'll continue to see. You asked about crypto. I think crypto is a big topic, but it does seem clear that on the regulatory side, obviously China has spoken pretty loudly. It does seem from every signal that is publicly available, given by the SEC, that there will be they are looking at, all areas within crypto. I think DeFi will probably be one area where they'll spend even more time, just given the nature of the way that product set works. But I think generally, I'm still very bullish on, crypto and blockchain technology in general, and the way that it's going to be innovating not only how we interact with money and money movement, but also in terms of the next level applications that they're going to unlock. We've seen a little bit of that already come through with the way, NFTs have created a new mechanism for people to engage with, products that they like, artists that they like, potential other creators that they like. And I think we'll see more sort of second order applications built off of the attributes of blockchain and crypto that will unlock new ways of engaging with the internet. I think on the sort of fintech or money side, I think other interesting areas that I'm spending time on are where the actual consumer still feels like they're interacting with a normal fintech application or banking application, but on the back end, the way that the crypto attributes and the blockchain attributes are actually making the money movement in the back end much faster and seamless. So even me as an end consumer may not know that that's what's happening in the back end because I'm getting, my money fast, whatever it might be. The back end is actually being powered by crypto or blockchain companies and infrastructure that helps make that happen. So I think we're just at the very early innings of a lot of this, but if I think about taking a long-term view, I'm quite bullish on where all of this could head. And I think generally regulation, will be important, but it'll also give some clarity to entrepreneurs in terms of like what is clearly in the green versus what's not, and then they can hopefully morph their business models and their approaches to make sure that they fit accordingly to that. And my hope is that the regulation helps spur further innovation, doesn't shut it down, and that's my optimism and belief in the system.
All right, and Ansaf, you've been in the enterprise and the fintech space. What advice would you give to investors to have a flexible mindset? Because there are a lot of changes which keep happening in the technology. How do you keep updated with new things which happen in the market?
Yeah, it's a good question. I mean, the pace of innovation only continue every year. Feels like it's faster and faster, and especially in the crypto space, because we were just talking about it. Obviously, it's feels like every week is a different year in many ways. But I'd say that the pace of innovation can be dizzying at times. But I do think that the fortunate place that investors sit in is that we get to meet not only amazing founders, but also learn a lot through osmosis with our own portfolio companies, but also we get a chance to meet with a lot of folks who are in and around these industries, and so the goal and the hope for an investor is to be able to continuously expose yourself to areas that you're spending a lot of time in, but through different lenses. So like, for instance, in the fintech or crypto lens, not just spending time with entrepreneurs, but spending time with regulators or folks who have a perspective or point of view on that. So you have at least some informed view on where this could or couldn't go. Meeting with operators, folks who have scaled those companies and existing companies in these spaces. So you have a sense of where their head is at, what's on their general mind and roadmap, and where they might be heading, so that can inform your decision making around investment. So I think it's an ongoing, continuous learning that all investors go through, and that's part of the fun part of the job, but also in these days something that you have to be very mindful of given just the constant pace. I do think we've kind of gone away to some degree from a world of being a pure generalist, because I think that each of these sort of subsectors requires a reasonable amount of attention. It doesn't mean that you can only focus on one subsector, but I do think you can't focus on all either. So I think some healthy middle ground probably has to be achieved. And I see that happening more and more, both within VC firms broadly as they think about sector focus, but also at the individual partner level. How do you spend time to make sure you've got the right depth of expertise so that when a company comes through your door, you have the prepared mind and perspective to be able to say, hey, this is a company that we obviously need to be paying attention to. And more importantly, I have something to offer and value add to the entrepreneur as they think about their strategy and their approach to this area.
Got it. And I quickly want to do the top three. What's a favorite business book?
Oh, good question. My favorite business book is by Phil Knight, which is called Shoe Dog. And there's a few reasons why I love it. One, because I grew up in Beaverton, Oregon, which is the headquarters of Nike. And so I grew up 10 minutes away from Nike. And so I've always been fascinated by the company. And obviously they have a huge impact on culture and on sports. And so I've just always enjoyed that company. But I think what was interesting about that book in particular was two things. One, that he really kind of let you into his mind and showed you sort of the both ups and downs of an entrepreneur, almost in a month by month playbook of his early days at Nike. And I think that was just from an empathy perspective, it's just a great way to understand what it truly means to go through his journey, at least. Not all journeys are the same, but at least his journey. And then second, it was a time before venture capital. And so there's very interesting anecdotes in the book about him going to the bank and trying to get a line of credit as he continues to build his business and the pains that he had around that. And I think it's, for somebody who's in the venture business, it's a pretty interesting precursor to, I think, what now enables so much innovation, which is, venture capital.
And if you could go back in time when you started your career in venture capital, what is the one thing you would have focused on or done anything differently?
That's a good question. I would say, I think, let me think about that. What I've done differently. I think one thing that all new investors, think through is, building enough reps to get to a level of your own conviction, right? Because if you're doing investing for the first time, you know what you know, but you don't know what you don't know from, having enough experience of what's worked and what hasn't worked. And I think that just takes a natural progression of time and, and certainly just cycles of meeting with companies and thinking about investments at companies where you start to say, hey, my thesis on this early stage company actually played out to be correct. And that happens enough times, you start to build your own level of conviction, even if that's non-consensus. And I think having an eye towards that as early as possible, both for myself, but also for any prospective investor, I think is an important thing to keep in mind. And I think you can't do it overnight, but also you don't want to wait too long to do that as well. And so thinking through, making sure you gut check yourself and making sure you're building your own level of conviction as you think about making your own investments. And the way I think you can start to shortcut that is just to really keep a strong track record of yourself in terms of deals that you passed on or ended up investing in, or even before you formally invested in it, would you have invested in that company? And kind of keeping a little bit of that tally in your head gives you an opportunity to build conviction even before you see some of the returns come out and all that, because that just takes time and years to play out in full. And so I think that's one way you can start to shortcut your own conviction. And having that conviction, I think, is what makes you distinct and makes you a great investor in the near term. And so trying to build that as quickly as possible, I think, is one thing that folks should just keep in mind. And I wish, I obviously, continue to keep in mind as I build my career in venture.
Got it. And do you have any favorite business, online tool, for example, Gmail, Slack, Zoom?
Well, I live on Zoom every day, so I don't know if it's my favorite, but it's probably my most often used. Let's see, what is something that I use a lot? I used to be, or I still am, a pretty frequent user of this tool called Bear, B-E-A-R, which is a notepad tool. And actually, Apple Notepad has gotten quite good now, but for a while I was on Evernote, and then I finally migrated to Bear, and I really enjoyed it because there's a lot of sort of mechanisms there in terms of how you organize your thoughts and notes. And it's sort of an easy interface to be able to write and keep track of things. So it's probably my favorite, or beyond Zoom, my most favorite and frequently used tool that I use online.
We'll put that in the show notes. And so what is the best way people can reach out to you and know more about Lightspeed?
Yeah, you can reach out to me directly with my email. It's my first name at lsvp.com, and happy to engage with folks. And generally we've got a lot of content online. We've got content on Twitter. You get to know, like I was mentioning, I think every investor tries to create a little bit of their thoughts online around where they think certain areas are trending, or at least on Twitter from a day-to-day perspective. And I think that's a great way to not only get to know me, but also the broader firm and other folks at our firm as well.
Got it. We'll put that in the show notes. So thank you so much for taking on time speaking to us. I really enjoyed my conversation with you.
Yeah, thank you so much. Thanks for the great questions, and I hope it's helpful to you and your audience.